What's up, traders and investors? Welcome to TradersArmy.com's Options Foundations. In this particular web series, we're going to be heading into the world of option risk graphs to help us understand the risk and reward characteristics of some simple options positions that will allow us to build and customize our options positions and truly understand our risk reward situation in every single trade. Now, again, if you guys need any sort of assistance or help on any of this, or just have some simple questions for us or some advanced questions for us, always reach out to us as soon as you possibly can at support@tradersarmy.com, and we'll be happy to help in every way that we can. Now, as we go into defining risk graphs and helping us decide or helping us determine what the risk characteristics are of our positions, we understand so far that going through this web series that when you purchase a call option or when you purchase a put option, you have to pay the premium. The most that you could lose in a position where you paid a premium out of pocket, the most that you could lose, worst case scenario, is the premium that you paid. The worst case scenario, you don't use your option, you lose the premium. When you sell an option, the risk characteristics are much greater. In most cases, when you just simply outright sell an option, the risk can oftentimes be more money than you have in your account, and in some cases, infinite risk characteristics. Now, does that mean that we're taking infinite risk when we get into a position? No, because we are going to be using exit strategies and exit positions, protective stop losses, to help us minimize those risks. But it is important that we understand what the overall risk characteristics are for any one of these positions. Now, how do we decide whether or not to choose a long position, a short position, or a combination using spread trades? Well, again, that depends upon the overall implied volatility environment. Volatility is the key here. There are option strategies out there for literally every market environment. Up, down, sideways, volatile, not volatile, you name it. But if we use the wrong trade at the right time, the wrong options trade, that is, the strategy at the wrong time, then we're not going to really be able to maximize our income, maximize our profit potential. We may not even be minimizing our risk. We may be minimizing our reward potential while maximizing our risk, and that's backwards. We don't want to do that. So in order to make sure that we are choosing the right options trade for the volatility environment, we use the volatility charts, either from your own brokerage account, overlaid a sub indicator to your charts, as I showed you in my Thinkorswim charts, or just go to ivolatility.com. You can get volatility charts. They're delayed by 1 day, but you can get them for free. And again, break it up into the upper 20%, lower 20%, middle 60%, and wherever volatility is, this will help us determine which trades are the most appropriate for that particular volatility environment. So as we get deeper into the option strategies themselves, there is a whole list of strategies that we will be covering here in individual web series just based around rules and criteria and management of long call positions, long puts, bull call spreads, bear put spreads, bull put spreads, bear call spreads, iron condors, diagonal calendar spreads, you name it, short calls, short puts. We're going to be coming at you with every single strategy that is useful for every market environment, and the most used strategies based upon the volatility environment that we would typically be operating in, which would typically be about the middle 60% of its range. And what you'll find is that you'll have an outlook on the underlying to help you choose which particular strategy is the best. Your implied volatility outlook. We'll get into strike price selection. How much time until expiration do we need to make sure we have? What net delta position we need, what net theta position we're looking for, and even net vega volatility exposure we're looking for, and an overall risk profile. And this is the column that we're going to focus on today for some basic understanding of risk graphs and why they're so important. So a simple way to kind of visualize what your option position really holds in terms of risk or reward is what are known as risk analyzers or risk graphs. A lot of your professional grade options trading platforms are going to have risk graphs already built in to the trading platform. And it's one thing to to have them available to you. It's another thing to have them available to you and understand how to actually use them. But before we dive right into option risk graphs, understand that every single position you could possibly take in the market, whether it's options, futures, forex, or just basic stock positions, they all have risk characteristics. And when we understand our risk and reward characteristics, we can better understand the position that we're in and whether or not it's the right position to be in or not. So we'll take a simple long stock position. Okay. Now, never mind the graph that you see in front of you on your screen right now. Just think about your risk and reward characteristics related to being long the stock at $50 per share. If you were to buy stock for $50 per share and the stock were to go up or down, how much risk do we carry per dollar? Well, we carry a dollar per risk, a dollar for dollar risk and dollar for dollar reward. Do we have defined profit potential or unlimited profit potential in this position? Well, we have unlimited profit potential because we simply own the stock. The higher the stock goes, the more money we make as long as we own it. When we see the stock go down, do we have unlimited risk potential or do we have limited risk potential? Well, we have limited risk potential. We can only lose whatever the stock cost us. Now, for us to lose $50 per share, the stock has to go all the way to zero, which is highly unlikely. But we're going to make or lose dollar for dollar no matter which way the market goes. If you were short the stock, the inverse would be the truth. Whereas you have limited profit potential, you're short, you need the market to go down. If you're short, you need the market to go down. The market can only go down to zero. So you have limited profit potential all the way to the stock going to zero and infinite risk in a short position because you lose money when the market price goes up when you're short stock. And since the market has no cap on how high prices can get, there is theoretically or technically unlimited risk in a short stock position. Now, of course, we're going to minimize our risk in every trade with protective stop losses. That's the very basic way to limit risk. We'll get into how options can play a part in risk management a little bit later, but let's first focus on what the risk graphs are going to be telling us. And we can look at this concept visually of infinite risk, infinite reward, capped profit, unlimited risk, unlimited reward scenarios by looking at graphs. All right, so let's dive right into the graphs. First of all, it's important for us to note that there are three important areas on a basic, call it naked graph. There's no position on this graph, but every graph is going to have an x-axis, which is your horizontal axis down below. It's actually going to have two horizontal axes, right? And we'll talk about what each of them mean. And we have a y-axis, this vertical axis on the left. Now, the vertical axis on the left is going to represent our break-even price in the underlying position, our profit, if we have one in the position, above the break-even line, and our loss potential below the break-even line. Now, whether or not we're in a profit, break-even, or loss position on the vertical axis would depend upon what price the stock was purchased or sold at, and where the current price of the stock is now relative to where you bought it or went short. So one thing that we look at is that we'll just look at a stock position, for instance. So if we purchase the stock for $50 a share, our break-even purchase price is $50 a share. So boom, we put a dot right on that break-even line, okay, at $50 per share. So we'll go straight up from 50 to the break-even line and we'll put a dot on the chart. If you're doing this by hand on a sheet of paper, then you would draw a dot right there at 50 because that's your break-even price. Now, what if the stock price goes up or down? What happens? Well, if the stock price goes down to 45, we're going to lose money. If it's down to 40 or down to 35, we're going to lose even more money. And the graph on the left obviously is not to scale. Okay, but we would be losing $5 a share if the market went down $5. Okay, this is not actually to scale. It's just meant to give you kind of an identifying visual representation. So if this were to scale, when we saw the stock go down $5 from 50 down to 45, you could look over to the left and see a $5 loss on your hands. If the market price goes up to 55, you could look to the left and see a $5 profit on your hands. If the stock continued to go higher to 60, you would see a $10 profit on hands, or even 65, you would look to the left and see a $15 profit on hand. And these two lines, the green line going up the graph, represents how much profit we have in the trade so long as the market stays above our break-even price. But the moment the market price goes below our break-even price, everything gets red and we actually show a loss all the way to the stock going to zero. Okay, so dollar for dollar, profit or loss on this long stock position with our break-even being at 50. If we were short the stock, the exact opposite would be true, meaning we'd still have a break-even of 50 if we sold short the stock at 50. We'd still have a break-even there at 50 bucks a share, but what would happen if the stock price went up? Well, if the stock price went up, we would be losing. If the stock price went up to 55, you could look up and look to the left and see that we were down $5 a share as long as this were to scale. Okay. In the event that the stock price was going down, right, which is where we need it to go, if the stock price is going down to 45, down to 40, down to 35, then we would actually see a profit all the way to the stock going to $0 a share. But there's no reason for us to go down to 25, 20, 15, 10, $5, $0 per share, even though the risk graph would display that, because the odds of the stock actually going to zero are highly unlikely. Also, the odds of this $50 stock being at $1,000 a share anytime soon is also unlikely. However, when you are short stock outright, you have dollar for dollar risk reward. So this is just going to basically, for your long and short stock positions, have a diagonal line taking you into the loss or the profit zone above or below your $50 break-even price in this scenario. Now, when drawing risk graphs for options positions, there's a little bit more that we have to consider when drawing them for options, because we have max loss or max profit positions that are going to be different for each position, whether or not we take a long position or a short position, whether or not we are buying calls or whether or not we are buying puts. So we have to build a risk graph in individual steps, right? And the steps are as follows. These are 1 through 5 steps. Number 1, and we always have to go in this order to get the risk graph drawn correctly, okay? And I'm going through this because I want you to understand how risk graphs are built, but then we're going to go into the actual trading software and we're going to show you exactly how the risk profiles are set up for us inside our trading accounts. So these 5 steps in this order, do not skip one, do not do them out of order, you will mess it up most likely. So in this order, start with question number 1. How much, if I have a max loss position, how much is that max loss? If I have a max profit position in this trade, how much is that max profit? And this would be based upon whether or not you took a long or a short position, regardless of calls or puts. So let me give you, for instance, if you purchased calls or puts, doesn't matter which one, but if you purchased calls and puts, you have a max loss position of your premium paid, because you can't lose more than the premium you pay when you go long. But you have an unlimited, infinite profit potential in long calls and long puts. So you would say, do I have a max loss or a max profit position? Well, if you went long, you'd have a max loss position. So we'll start there. If you were short the options, this means that you sold to open the option position, you took in premium, and that premium would not be your max loss, that premium would be your max profit if you went short the options. Okay? You'd have infinite risk, technically speaking, if you took a short call or put position, but your characteristics are always going to start with, do I carry a max loss potential in this trade, or do I carry a max profit potential in this trade? And always, 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 for your simple 4 legs, long call and put positions carry a max loss of premium paid. Short calls and puts carry a max profit of premium received. Once we identify that, we're going to draw a horizontal line at our either max profit or max loss position, depending upon whether we're long or short. Then we're going to ask the question and calculate, what is my break-even price in this trade? And the break-even price isn't simply the premium you paid or premium received. We have to consider the strike price of the option that we either bought or sold. And so to determine the break-even price for call options, the simple equation is always strike price chosen plus premium equals break-even price. This is regardless of if you took in premium as a seller or you paid premium as a buyer. For put options, the math is backwards. It's different. It's the opposite. Strike price, you decided to trade, subtract the premium, that will give you your break even. Now we're going to place that dot on the graph at our break even price on the break even line, showing if the price of the stock lands at our break even price, which for calls again is strike price plus premium, for puts is strike price minus premium. If the stock lands at our break-even price at expiration, we have not made or lost money. We have broken even in the trade. Anywhere above or below our break-even price, and we will have a profit or a loss in the trade, depending upon which trade we took. And then we want to connect that max loss or max profit scenario, that horizontal line that we drew, to the break-even dot by drawing a diagonal line. Now, I know a lot of you are probably thinking, if not all of you are thinking, I have no idea what these steps even mean or what I'm going to do with them. And that is why we're going to go through these steps together for all 4 basic option positions so you can start to understand how options risk graphs are built. So again, going through the questions in their order. Number 1, we have to ask, do we carry a max loss or a max risk position, max risk or a max reward potential position in this trade? Well, what is the trade we're looking at? Well, we're looking at a long position. We're going to buy the $50 strike call, and we're going to pay $3 per share for it. So we know 2 things so far if we look at buying this option. We know 2 things. We know, 1, that we have a max loss potential of $3 per share. How do we know that? 1, we're buying the option, and we can't lose any more than we pay for the option. So we know we have a max loss of $3 per share. Okay, so we know that. Now, what would have to be the case at expiration? Where would the stock need to be for us to lose all $3? The stock would have to be, for it to have no intrinsic value and no extrinsic value, the stock would have to be at $50 or lower. So if the stock were at $50 or lower, what would we lose? All $3. That's where we have to draw this horizontal line. The horizontal line represents at 50 or lower, we have the potential to lose a maximum amount of $3. But notice how this is a horizontal line, not a diagonal line like it was in long stock. Why? Because this has a max risk characteristic of $3 per share. Okay, so if we had purchased the 55 strike call, well, then this red line would extend out to the 55 strike, suggesting that if we paid $3 for a $55 call, the stock would have to be at 55 or lower for us to lose all of our money. If we purchased a $45 call, the stock would have to be at 45 or lower for us to lose all of our money. Now, how do we determine our break-even price? Well, the simple equation is strike price, that's 50, plus the premium paid, that's $3 that we paid. Our break-even price equals $53 per share. Okay, so the stock needs to at least be higher than 53 for us to make any money at all at expiration. If the stock is at 51, well, we wouldn't have lost all $3. We would have lost $2. Why? And we're talking at expiration here, guys, at expiration. Okay, why would we have lost not all of our money? Well, if we own a $50 call and the stock is at 51, we can brag about that because we can buy the stock for $1 less than everybody else can if the stock went to 51. But we would still lose $2 of our money since we paid $3 for a $1 bragging right. If the stock were at 52, well, we would lose $1, but we would have $2 worth of intrinsic value in our option, so we wouldn't have lost everything. If the stock is 53, yes, we do have bragging rights over everybody else because we can still buy the stock for 50 even though the stock is trading for 53. However, even though we have bragging rights at expiration, it doesn't really mean anything because we had to pay $3 up front for those bragging rights to be able to buy the stock for 50. So when we draw that diagonal line from 50 up to 53, anywhere below 53 at expiration, and we are going to lose money. We are under our break-even horizontal line here. Anywhere under 53 at expiration, we have lost money. Anywhere at 50 or lower, we have lost it all $3, and that's it. Now, what about above 53? If the stock goes to 54, well, we will have $4 worth of intrinsic value. $3 covers our premium paid. $1 is a profit. If the stock goes to 55, our option has $5 worth of intrinsic value, which covers our $3 cost and gives us a $2 profit. And how much higher could the stock go? Well, the stock could continue to go to 60, 65, 75, 85, 105, 1,005 if it could. And at expiration, or before expiration, I should say, we have an infinite profit potential. But anywhere above $53 per share, and we actually go into the green, we actually make money at an infinite rate. So if we look at 55 here and we go straight up, and we were to look at this area right here, okay, right here is where the line is. Look directly to the left, and this will show you exactly how much money you are profiting by. You're in a profit of $2 per share. This would be after getting your $3 back plus the $2 profit you've actually made. That's your net profit. And the higher the stock goes, the more profit we make. And this risk graph will show us our infinite profit potential with our max loss scenario. This is an at expiration risk graph. Prior to expiration, this will be a little bit more curved, and we'll get to that when we get to the actual live risk graphs here in the trading platform in a moment. Moving on to the short call option. The short call option is exactly opposite the long call option. Literally exactly the opposite. Okay? So what I mean by that is somebody actually took the other side of this trade. And so their risk graph would look like this. And they would be asking themselves the same questions to build their risk graph in the same order. Number one, if I short this call option for $3 a share, do I have a potential for max risk, max loss, or do I have a potential for max reward? Do I have a defined amount of risk or defined amount of reward I can make in this trade? And because we are shorting, that means we are selling to open this call option. We sell it for $3 a share. That money comes into our account. We can't make any more than $3 per share. We cannot make any more than $3 per share. And the only way that we get to keep all $3 is for the buyer of that call option to lose all $3. So think back to a few minutes ago. Where would the stock need to be for the buyer to lose all $3 and for the seller to make all $3? For the seller to make all $3 at expiration and the buyer to lose all $3, the stock would have to be at $50 or lower. $50 or lower. So the horizontal line would be drawn at $50 or lower, but in this case it's drawn in the profit zone. Why? Because we took in the $3 and we have a max profit potential of $3, which is the opposing position to the max loss position of $3 for the person who bought this call option. So we have a max reward potential of $3 no matter how much lower the stock goes, down to 45, down to 40, down to 35, or down to 0. We can't make any more than $3 a share for this position. Now, what's our break even? The math is the same. Strike price plus premium collected, our break even is $53. So we put a dot on the chart at 53, and we connect this line from 50 with a diagonal line down to our break even. This shows that as long as the stock is below $53 per share, we will make some money, but the only way we'll get to keep all $3 of this trade is for the stock to be below 50 at expiration. What if the stock is above our break-even price and what we sold for $3 a share is now worth more than we even sold it for? Well, we have an infinite risk potential the higher the stock goes. Because think about what your obligations are here. You have an obligation when you sell a call option, and that obligation is to deliver stock. you have an obligation between now and expiration to deliver stock at the strike price selected, so $50 per share. So if you have to sell the stock for $53, but you brought in $53 worth of share, per share in premium, you break even, right? If you have to sell the stock for 50 and you brought in $3 worth of premium. But if you have to sell the stock for 50, says your obligation, if you have to sell the stock for 50, but the stock is at 55, and you have to go out and buy the stock for 55 and sell it for 50, well, you've lost $5 in the equity transaction. Sure, you've got $3 per share in the account for selling the original option, but if you lost $5 on the equity position and made $3 on the option position, you technically still lost $2 per share. And if this stock decides to go to 60 or 65 or 70 or 75 or 105 or 1,005, you're still obligated until expiration to deliver this stock for $50 a share to the call option buyer. So if this stock is above 53 at any time, you are in a losing position, no question, and the losing position has infinite risk characteristics. The profit position has maximum profit characteristics, which is the premium received when you open the position on this 50 strike call option. Moving on to put options, the long 50 strike put. Let's say we pay $2 for this put option. We pay $2 for the puts. Okay, so a little bit different scenario, but we're still using the $50 strike price. So let's ask ourselves, do we have a max loss potential in this trade, or do we have a max profit potential? Well, since we're going long, we have a max loss position of $2 per share. Now, where would the stock need to be for us to lose all $2? Well, let's first think about our outlook here. Our outlook when we purchase puts is that the stock is bearish, meaning we need the stock to go down when we purchase puts. So if the stock is at $50 or higher, we don't have any bragging rights at expiration if the stock is at $50 or higher. Therefore, if the stock is at $50 or higher, what happens to our option? Well, if we don't have any extrinsic value at expiration, and we don't even have any intrinsic value because the stock is at $50 or higher, and we chose the 50 strike put, we lose all $2. So the stock would have to be at $50 or higher. Now notice we draw the line from 50 to the right of the graph, not from 50 to the left of the graph, because that would represent $50 or lower. This particular trade suggests that if the stock is at 50 or higher, we lose the full $2. Now our break-even price, the equation for this is we take the strike price that we traded, which is 50, subtract the premium paid, which is $2 in this example, and that would take us to a $48 break-even. So we place a dot on the chart, we connect those dots, which would suggest, hey, if this stock is anywhere above 48, we will lose some money. If the stock is above 50 at expiration, we lose all $2. But if the stock is below 48, we have unlimited profit potential all the way to the stock going down to zero. So if this stock keeps going down, our position continues to profit as the stock keeps going down. But if the stock keeps going up, our position cannot lose more than what we paid for it. As the benefit of buying the options is that you can't lose more than you paid for it. So think about it. Let's say, for instance, the stock is at $45 a share. Stock's at 45, we're at expiration. Do you have bragging rights? Yes. What is your rights? You have the right to sell stock for 50 in your put option contract. So if you have the right to sell stock for 50 and everybody else has to sell the stock for 45, you have $5 worth of bragging rights. But you didn't make $5. You actually paid $2 for those rights. So when you subtract the premium from your bragging rights, you end up with look straight up from 45, a $3 profit if the stock is at 45 and you paid $2 for the 50 strike puts. Okay, if you paid more for those puts, this max risk would be lower and your break even would be lower as well. If you paid less for the puts, your break even would be smaller. Okay, your break even would be smaller, not higher. and your break even would be not quite as low. But since we paid $2 for this 50 strike put, our break even is 48. Our max loss scenario is that the stock is at 50 or higher, and we have infinite profit potential all the way to the stock going to zero. And last but not least, the short put. The short put is the exact opposite of the long put. So someone brought in $2 a share when someone paid $2 a share. So in this scenario, we have a max reward potential when we ask that question, do I have a max loss of $2 or do I have a max reward of $2? And in this example, we have a max reward of $2. So we stand to make $2 a share in this trade if the stock is where? Where would the stock need to be for us to make all $2? Well, it always starts with 50, right? The stock would have to be at $50 or higher for us to make this. It's always $50 or higher if we sold the put, the $50 put, for $2 a share. And we draw that horizontal line starting at $50 a share on the underlying, and we would go to the right on that, and we would draw it as high as $2 profit. If we collected $4 for those options, this green line would be up here representing a $4 max profit. Where's our break-even price? We take a look at the strike price minus the premium collected. That takes us out to $48, and we put a dot at 48. Remember, the break-even for the long and the short are the exact same when you remove the commissions. The break-even for the long and short position at that time are the exact same. So how do we calculate? How do we draw these lines? Well, now we're just going to simply connect this green line that shows our max reward price point to the dotted line. This shows that if the stock is anywhere above 48, the seller of the put makes some money, the buyer of the put loses some money, but if the stock is above 50, the buyer of the put loses all of their money, and the seller of the put makes all of their premium, which is the $2 in this case. Anywhere below $48 a share, and we actually have an infinite amount of risk. Theoretically, you can't lose any more than when the market goes all the way to zero on this, but if you're doing this in a margin account, you don't have to have the $50 in your account to actually trade this. Because think about what your obligations are here when you're short this 50 strike put. If you're short the 50 strike put, you have an obligation to buy stock for $50 a share. If you have to buy the stock for $50 a share and the stock is at zero, you've lost $50 on that stock. But you collected $2 a share in premium, therefore your real loss is only $48. That's why your break-even price is sitting right here at $48. But anywhere below 48, if this stock keeps going down in price, again, if the stock keeps going down in price and you're still short the 50 strike puts, you have technically infinite risk all the way to the stock going to zero. But we're going to use protective stop positions to make sure that we protect our risk characteristics, and we're not carrying the risk all the way to zero. That would be silly and not a good risk-reward scenario. So again, if you're short the options, you have max reward potential. If you're long the options, you have a max risk potential. And these four basic risk graphs will actually become the basis for every trade that we make in the future. Every single leg trade, like we just saw, every multi-leg trade, like spread trades, diagonal trades, vertical spreads, anything that we can think of, there is a risk graph that can be plotted for that to help us determine our expiration risk profile, at expiration risk profile. Now, ideally, what we're going to be able to do after going through all these web series and understanding the options is we're going to be able to hand draw on a piece of paper, or graph paper if you'd like, hand draw all of our risk profiles for the trade that you're about to make. And I would go so far as to say that if you cannot hand draw the risk profile, as we kind of just did there, if you can't hand draw it on your own without using a calculator to do it for you, as I'll show you next, then you really don't understand the risk reward characteristics of that position, and you really shouldn't be making the trade. So I remember going through my learning phase of learning how to trade options, and one of my very first mentors told me, learn how to draw the risk graphs by hand, and you will understand the risk and reward characteristics of every trade that you ever make in a very intimate way. And I think that's going to lead to understanding options that much better, that much faster, much more efficiently, and help you understand exactly what you're doing inside the options market, no matter what the trade is. Simple single leg position or a four leg, you know, multi-spread trade position. Doesn't matter. We're going to draw them all by hand as we go through each web series on every strategy. But before we end, I want to actually take you over to the risk graphs that are given to us within the trading platform so you can see how they're all plotted for us and how we're going to use them. Okay. Let's go over here to the trading platform. Now, I've already loaded up. This is the Thinkorswim platform. Whether you use a different platform or not, you should make sure that you have the ability as an options trader to have these risk profiles built for you so you can understand what it is that you are trading. So they have a tab up here known as the Analyze Your Trades. So we're going to analyze a simulated trade. So if I go to Analyze, and I'm just going to go to the SPY, and I'm going to go down to, I'm just going to randomly pick an expiration here. I'm going to go out, and I'm going to see more strike prices. So I'm going to list a few more strike prices, okay? But ultimately, I'm going to go out, and we're going to purchase an at-the-money option. Now, this particular platform really makes it easy for us because it details the in-the-money options versus the out-of-the-money options by highlighting all of the in-the-money options on the calls, and the out-of-the-money options are not highlighted. On the puts, the in-the-money puts are highlighted, and the out-of-the-money puts are not highlighted. And where those two yellow highlights sort of meet, they kind of correspond with one another, right around that area, that's your at the money strikes. And so right now you could choose either the 264 or 265 strike price and look at the current price of that stock, and you would see you are right there at the money if you were to look at either one of these strikes. So the way to start actually simulating trades and having a look at the risk profiles, you have to actually enter a trade in. You don't have to enter the trade as in get in the trade. All we're doing right now is adding a simulated trade so we could analyze the risk profile. These are the three buttons up here that we're going to be focusing on using the most right now, which is analyze a simulated trade and its risk profile. That's the second button over here. Now when you pull up the risk profile, with no position down below added, okay, all it has for us is nothing. It has nothing. It has a y-axis and it has an x-axis. It shows the current price of the stock right around 264.63, and you'll see some vertical dotted lines here above and below current price. These are what are known in this platform as price slices. So I'm going to click on this little triangle, this little arrow here, and drop that down. And what this will show us is that by default, this shows the middle slice. The middle vertical slice represents zero profit or loss on the underlying, meaning the market has not gone anywhere. This is the current price of the market. 10% higher or lower, meaning if the stock price itself goes 10% lower or 10% higher. And that's just the default. We're going to actually use some different numbers when we get into trading. These will represent our stops, our entries, our targets. This will actually show us our real-time option Greeks, our delta, our theta, our vega, and our important part here as well, our profit and loss for today and our profit and loss since we opened the trade. So this is going to actually not just show us our expiration risk profile. This will also show us a real-time risk profile, which is really, really helpful in your option trading. But right now, again, as I pointed out in the previous graphs, our zero line is this horizontal purple or black or gray line, depending on what it is you're seeing on your charts. It's a horizontal line. Anything above that's profit, anything below that is loss. And down below on the x-axis represents the stock price, right? So if the stock price goes higher, that's to the right. If the stock price goes lower, that's to the left, okay? So let's go back to the add simulated trades here. And let's do a couple of examples. So let's say we're going to add buying the $264 call option. Well, we're going to pay $6.35 for that call option, $6.35 on the ask price. And there is currently, because it's the 264 strike, Looking at the current price of the stock, it's 264.46. 46 cents of that premium is intrinsic value. The rest is extrinsic value. How you know that? You can customize your option trading platforms. Right now my layout is set to use last price and the net change for the day. If you click on intrinsic or extrinsic value, it'll populate that for us down here. So I'm going to keep just this information simple, because all I want to do is I want to click on the ask price. If we're buying it, we're going to click on the ask. If we're selling it, we're going to click on the bid. Now, it doesn't mean we're paying or receiving this premium. We can negotiate this spread a little later, but right now we're just going to analyze it. So 635, I simply left click on that, and notice how it dropped in a simulated trade down here. So if you just buy one of the March 2018 264 call options and it costs you $6.35, or maybe you can get it for a little bit cheaper as we're looking to negotiate the spread. You know, someone out there says, hey, I'll buy it for $6.23. Someone out there says, I'll sell it for $6.35. That's what the bid and the ask is in every market. You may say, all right, well, I'll buy it, but I'm not going to pay you $6.35. I'll pay you $6.30. And maybe you'll get it for $6.30. Okay, you wouldn't be able to get it for $6.23. You'd have to go somewhere in the middle of the spread. And we'll discuss strategy a little bit later in a different web series, but just for example purposes, roughly 50% of that spread is a good average price that you can get in. But we'll just keep it simple and we'll go for $6.30 here. Now, we're not in this trade, but let's go click on this risk profile button, and what you'll notice is that it actually drops in a risk profile for us. Now check this out. The green line represents our expiration risk profile. Might actually be difficult to see in the color green, so let's make it black. Here we go. So the black line now represents our expiration graph. How do we know that? Well, look at this little legend down here. This little legend in the bottom corner tells us on March 17th, 2018, which is expiration, we have a loss potential of $630 if the stock is, notice how I'm going left to right, below $264 per share. If I go left to right, anywhere below $264 a share, that $630 loss doesn't change. Doesn't change because we have a max loss of $630 a share times 100 shares. Max loss. Now, what if I go to $680 a share? I'll just put my cursor right over $680 as close as I can get, $680.06, right? So I've got $280.06. $280.06 is where my current Mickey Mouse hand cursor is sitting. $280.06. Now, if you look back over here at the legend, I'm not going to move my cursor because it would change everything, but if you look back over there at the legend in the bottom left-hand corner of the graph, you'll see that we would have a profit of $976.16. It's changing a little bit, $975.16. It's changing a little bit because the market is still in just after hours. So this stuff is going to change in real time because we're looking at a real-time risk profile. Now, that's an expiration graph. The real-time risk profile is this purple line. Now, the purple line is going to evolve as time goes on. Now, how's it going to evolve? Well, it's going to evolve in a way that causes the purple line to eventually evolve into the expiration line. Now, what do I mean by evolve? Well, if you remember from the just previous web series on option Greeks, time decay is our enemy in this trade. Theta is working against us. In fact, if you look down here at our theta, this is our position theta right now. If we purchase this, we are losing $2.64 per day just in time decay. And eventually, over time, all of that extrinsic value has to go away, and theta is what's going to decay the value over the next 105 days, all the way out until expiration. So if we hit our profit objectives before expiration, let's say our profit objectives are $280. We think the SPY is going to $280 a share, and I'm not saying that's a real trade. I'm saying hypothetically speaking, if you thought the stock was going to 280, Look at the legend down below. The legend down below says we would make, by, if this happened today, December 1st, we'd make $1,062. If it happened to be there at expiration, we'd make $967. So we would make less because time decay would cause us to lose some of that extrinsic value. If we had a stop loss at $260 per share, let's just say, we would lose $630. Look at the legend in the bottom left-hand corner. We would lose $630 today. I'm sorry, at expiration, but we would only lose $209 today if it dropped below $260.03. So this real-time risk profile is going to help us really more accurately identify our true risk-reward scenario based on how much time we have left in the trade. And so one cool thing about this is that all this is based upon today's date and expiration. So you might say, and we'll get really deep into using these. I just want to show you for example purposes as we're talking about risk graphs that not only can we hand draw them, and you should learn how to hand draw them by going through the steps we already discussed in this web series, we are going to have a very in-depth look at each and every position that we take in the analyzers here using this particular platform in every other web series that we do on the actual trades. So we can say, okay, well, what if it doesn't happen today? What if, and I changed the calendar date, what if on December 8th, what if on December 8th we hit our stop loss? Well, on December 8th that we hit our stop loss below 260.03, look at the legend now, we're going to lose $227, right? So we will have lost more because time is taking away $2 and roughly 70 cents each and every day. And notice as you get closer and closer to expiration, we'll go to, I'm just going to go one day at a time. Notice that purple line in real time is getting closer to the black line. Watch this. I'm going kind of fast, just clicking one day at a time, one day at a time. Notice how time decay is getting faster, theta is getting faster. So we're now losing $5.40 a day if we're all the way out in mid-February. And that purple line shows us that if we get our stop loss hit in mid-February, we're going to lose closer to our max loss of $630. It says we're going to lose $473 if we hit that point. Okay, if we go out even further, notice our theta is getting even faster. It's taking away $8.28. It's exciting, isn't it? Now we're even closer to losing our max loss if our stop loss is hit on 3/5, which is March 5th. We're going to lose closer to $630. We will lose $562.60. And if we take this all the way out to expiration, notice how the purple line is gone. Well, the purple line has basically become the black line. And so if we hit our stop loss on expiration date, well, we have a max loss scenario. But we can't lose any more. Doesn't matter if the stock is any lower. As high as the stock happened to go at that time, obviously we make an unlimited profit potential if we bought the calls. If we really quickly went out and bought the put options instead, we click on the ask, it drops the put option down there. Notice how our risk profile, let's go back to today, our risk profile is just reversed. Okay, so it shows our max loss scenario. We're going to pay $603 for the options. Anywhere above $264 a share and we lose, look at the legend, $603. Okay, anywhere below $264, which is the strike price we've chosen, plus minus our break even. Here's our break even price. What's cool is this platform actually shows you in a slightly, it's a really small but red vertical line here. This shows you your expiration break even. So if you hover your cursor right over that, it'll show you your expiration break even, and it'll show you your real-time break even. So this is a real-time risk profile analyzer that allows you to build options positions and model out your risk-reward scenario before you ever even get into the trade. This, my friends, is an incredibly powerful tool for you to learn how to use. and we are going to be exploring using risk profile tools and analyzers for every single trade, because it's important that we understand what our risk reward scenario is based on what we expect to happen with the stock, what we expect to happen with volatility. We can throw all kinds of what if scenarios at these risk profiles, and it'll tell us, what if 10 days goes by and the stock goes down $5 and volatility changes by 2 percentage points. We can throw all that what if scenario at this. We can throw it all at this, make adjustments to volatility, adjustments to interest rates, adjustments to time, adjustments to stock price, and this will give us our real-time expected risk reward scenario here, our expected P&L. So we didn't do any of that in this particular web series. All I wanted to focus on in this particular web series is what are risk graphs, why should we care, because that's going to actually set up for the next series of web classes we are going to start to get into next, how to trade the options and particular strategies, rules around the strategies, how to analyze risk reward for that strategy. We'll set up real-time trades. They will be, obviously these are recordings, so you won't be taking these real-time trades, but we'll be setting them up together so you can see the process from start to finish, and that starts next. This, by the way, folks, ends our, call it, foundational series on terms, definitions, terminology, all of that kind of stuff. Now we get into actual trading of options. So we look forward to seeing you guys back. If you have any questions, shoot us an email at support@tradersarmy.com, and we'll be happy to help in every way that we can. Thanks for joining us. See you in the next web series. Take care.